Hi, my name is Jay Goodis, and I'm the co-founder and CEO of Tax Templates, Inc. There are two key pillars of the passive income proposals in Federal Bill C-74, which both take effect for taxation years beginning after December 31st, 2018. The first is a clawback of the small business deduction at a rate of $5 for every $1 of adjusted aggregate investment income. This is a newly defined term. The SBD clawback occurs when the passive income of an associated group exceeds $50,000 in the previous taxation year and is fully clawed back at $150,000. The second change amends the existing refundable tax regime by creating two new refundable dividend tax pools, a non-eligible RDTH account and an eligible RDTH account. To highlight these changes, I'll be using TTI's corporate tax scenario worksheet. I built a 3-year plan for OpCo, which has a December 31st year end. Starting in 2018, I've included an opening RDTH balance and an opening GRIP balance. I've assumed OpCo has a mixture of income, such as active business income, other Canadian investment income, net capital gains, and eligible dividends. Now, the worksheet will determine for us what the total corporate taxes will be, the net cash after corporate taxes, provide dividend recommendations, and show us the carry forward balances to assist with any planning. As we look at 2019, we can see the results of these new changes. To accommodate the transition to multiple RDTH accounts, the 2018 ending RDTH balance is prorated in line with the legislation between the NE RDTH account and the ER DTH account. In 2019, the worksheet will automatically populate the AAII balance. You'll notice that the SBD has been ground down from $300,000 to $175,000 as a result of the AAII. We have also left the AAII overridable for unique adjustments such as capital gains that may arise from active assets. Now, the new challenge in determining our dividend strategy, as dividend planning and optimization are now more complex. The payment of eligible dividends will only return a dividend refund from the ER DTH account and cannot return any balance from the NER DTH account. A CCPC that pays other than eligible dividends will receive a dividend refund from its NER DTH account first and can receive a dividend refund from its ER DTH account with any remaining portion. So the strategy that makes sense for most Canadian corporations will be to first pay out eligible dividends that will create a refund from the ER DTH account. This should be followed by other than eligible dividends that will create a refund from the NER DTH account. The next dividend consideration will depend on whether or not there is a GRIP balance. If there is a GRIP balance after dividends already paid, remaining dividends would be consistent with existing strategies by paying eligible dividends followed by other than eligible dividends. If the GRIP balance was fully utilized after the first eligible dividend, but an ER DTH balance remains, the CCPC should look to pay other than eligible dividends to utilize the remaining balance in the ER DTH account. Any remaining payouts would be as additional other than eligible dividends. So this complicated logic is embedded throughout TTI's corporate worksheets, which also optimize the difficult constraints on cash and the circular nature of the marginal cash from RDTH accounts. As you can see here, that once I include the dividend recommendations, the net cash retained comes down to nil, and any closing account balances are shown in the carry forward sections. Now, if you have any questions about utilizing these features, please feel free to email us at support@taxtemplates.ca.